happy to announce here Henry McVey as the next speaker. He's representing KKR. He's CIO and head of global macro, balance sheet and risk at KKR. And we are delighted to have him here today to speak. And Henry, don't get worried. I have here the German title. Diversifikation, über geostrategische Investitionen, die Globalisierung im Wandel, Neuausrichtung des alternativen Portfolios. Does it sound good, Henry? Yeah. Macht he will do his presentation on English, and yeah, we are delighted to have him here. Henry, he's really a rewarded asset manager and brokerage analyst. He has been rewarded for years by Institutional Investor as the best asset manager and brokerage analyst. And so he brings a lot of expertise and a long investment experience. And so we are delighted to have him here. Henry, come to the stage, and I hand over the micro to you. So welcome.
Thank you very much. Yep. Okay.
Welcome.
Okay. For those of you who don't know me, I'm Henry McVey. I've been at KKR 11 years. I'm a partner there based in New York. I spent 13 years at Morgan Stanley beforehand. Obviously, there's a lot going on in the global environment. So what I thought I would do is give you an overview of what we're seeing from a macro standpoint, and then tie that into asset allocation. I recently just got back from my first trip to China. Since COVID, I've been going there since '95, as well as Japan, and I'll tie that in terms of what we're seeing globally, and then hopefully there's some investment ideas coming out of that. So a couple of things I would say, which is we're shifting in a capital markets perspective from markets reacting to inflation catching central banks off guard to what inflation means for corporate profits and consumer balance sheets. That's a totally different playbook. Point number two is structurally our view at KKR is that we have a higher resting heart rate for inflation driven by shortage of labor in the developed markets, the energy transition, and then ultimately geopolitics. Our view is we're moving from benign globalization to one of great power competition. It's a big deal, right? General Petraeus works at KKR. We spend a lot of time between our macro effort, our geopolitical effort, and our public policies. That's a fundamental shift in terms of how we're looking at the world. That means there's probably going to be more volatility around inflation. Keep it simple. Last year, if you follow our readings, our mantra was walk, don't run. We thought it was going to be bumpy in the capital markets. What we're saying from here is that you can make a lot of money for investors by doing the simple stuff. Anytime the S&P trades down 25% or high yield trades down 85 cents on the dollar, you should be increasing your deployment, not pulling back. And then final thing is, KKR, we're probably the largest investor in everything we do. I serve as a CIO. We have about $18 billion of our own money invested in our funds. We have about $25 billion in total, including cash and others. And I'll show you how we're positioned. I'm not recommending it, given that we're 85% illiquid in our balance sheet, but it'll give you some instruction on how we're looking at the world. So when you take a step back, left-hand side, we've all invested in an environment of low inflation and low growth. And whether you're the ECB, the Bank of Japan, or the Fed, you actually were missing your mandate for about a decade. And so the central banks extended their risk curve to try to give you more visibility to encourage risk-taking because they couldn't hit their targets. Right? I sit on one of the advisory committees with the Fed in the U.S. It's very clear to me that they had to overextend to compensate. What's happened, we put too much money in the system from a demand side, and we've also got those three supply shocks that I talked about, labor, geopolitics, and the energy transition. And what that's leading to is it's moving us up to the top right quadrant, where you have lower real GDP but higher nominal GDP. That actually requires a totally different type of asset allocation. You got paid a lot to extend duration, to buy growth, and to buy long duration fixed income. That was the right call the last 10 years, and to do more of it in the US than any other part of the world. That is not what we're saying at KKR right now. We're shifting that quite a bit. I've been doing this 31 years. I don't say these statements lightly. We think we're in a regime change, and you got to shift what you're doing. You see the reasons on the right that I cited on why there's changes. It's going to be bumpy along the way. Like, let's go through the optimistic side. Why are we more in the pro-risk market right now? Top 25 central banks, 84% of them were tightening last year. That number is going down to probably 8% this year. So there's a fundamental shift. Do you want to be rolling the rock up the hill into the face of monetary tightening, or do you want to try to enjoy it not being a headwind? We're moving from a headwind to, I don't think it's going to be a tailwind, but it at least will stop being more of an issue. That's the good news. The bad news is on the other side. This is not your normal cycle. And you see that in the way inflation is coming off much more slowly. I use the US, but it's the same thing in Europe. Core services inflation is going to be stickier this cycle. In the US, Chairman Powell has told us that he likes to look at services, X healthcare, X energy. Today, that is higher than when he started raising rates, despite the fact that we've raised rates at a record clip. And it's a similar story in Europe as well. So this isn't normal. Most of us have all invested where you had the Fed or the ECB or the Bank of Japan missing their mandate. When you had a earnings crisis, you could extend the balance sheet and you could ease more quickly. Our base view is that rates have gone up and now they're going to stay stickier for longer. You've also got to have a global perspective. I think at KKR I was the second person from the United States to go to China, right? Most people in China have not seen foreigners. I waited in line an hour and a half in Japan to get into customs. I waited an hour today in Frankfurt. There were 6 people in the airport in China, 6 foreigners, right? What's going on over there that we need to pay attention to? China's 20% of global GDP. Their monetary growth is almost 13%. The US, it's actually contracting, right? They've got deflation, we have inflation. When I started at KKR, nominal GDP in China was 20%. Today, it's less than the US. So you've got a fundamental dynamic shifting where Asia was the complete engine of growth globally, driven by China, led to exports, benefited Germany, benefited the United States. You now have a much more asynchronous recovery between Europe, the US, and Asia. Very different than what we've had in the past. I mentioned this also, which is many of the clients, in my view, are actually underinvested right now. They de-risked when we had, when rates started going up, and many of them are looking for a pullback to get into the market. History would suggest that that's not actually the right approach. I started my career in liquid markets at Morgan Stanley. This is just data from there. Generally, when the market sells off 25%, you should actually be adding back risk. On a probability-weighted basis on a 3 or 5 year horizon, markets are up 90 to 100% of the time. On the right-hand side, one of the areas where we're seeing an extreme amount of opportunity right now is asset-based finance, direct lending, and real estate credit. Guess what's happening? When you look around the world right now, IPOs, levered loans, and high yield as a percentage of GDP are back to levels we haven't seen since 2007. This is not 2007. It's an incredible time. You can get high up in the capital structure, direct lending, you can make a 10, 11, unlevered, real estate credit, lots of opportunity. I think you're going to hear from one of my colleagues later on asset-based finance. That is a play on this higher resting heart rate of inflation. Very nice returns in that business as well. Equities are going to bring you more volatility, but I think the trend is probably higher. Credit, to me, is an action item today. This is a great time to be a lender as many of the banks are pulling back. What are the key themes that we're pursuing, right? KKR today is $500 billion. We're $250 billion in credit, $100 billion in real assets across real estate infrastructure, and about $150 billion in private equity, which is the industry that Henry Kravis and George Roberts invented when they opened up KKR in 1976. Point number 1, we're very bullish on asset-based cash flows, collateral-based cash flows. This is one of the most efficient vehicles for playing this regime change thesis. Asset-based finance, real estate lending, infrastructure. We've taken multiple $billion of our own money, I'll show you this in a bit when we get to asset allocation, on this simple premise that real rates this cycle will stay lower than in the past. That's going to be true in Europe, true in the US. I just left Japan. I've been going to Japan since 1995. I'm pretty convinced they're actually coming out of deflation. And they've actually been in a period where most people are sitting in cash. That's been the rational thing to do. I don't think that's the case if we go from deflation to inflation. So as a firm, we're putting a lot of our own capital behind this idea. More upfront yield, more pricing power, more inflation protection. You can see on the right-hand side here, it's just simple math. When you measure unemployment and you measure inflation, central banks waited the longest this cycle to start to raise rates, and that happened at a time when they're actually buying mortgages and other securities that help the housing market, even though we have those three structural issues: labor shortage, geopolitics, and the energy transition. Second theme, we've notably skewed our portfolio away from goods towards services. Goods was a cyclical phenomenon during COVID. People went out and bought, fishing rods, jungle gyms, all that sort of things for their kids. Goods has been in deflation for 20 years. Services has not. And you see this, our prediction is that red will keep going up and the blue will come down. So we are having a goods recession globally, right? And guess what? The Fed and the ECB are hitting their mandate on goods inflation. It's actually less than 2%. That's not the issue. It's services is where the action is. Services inflation, which is much more linked to wage growth globally, is still increasing. Definitely going to come down cyclically, but it's still increasing. If you look at where all the growth and employment is, it's not in goods. It's actually in services, and you can see that there. Point number 3, structurally, we think we're in a significant period, probably since the internet. This is the biggest CapEx cycle that we'll see as an investor base around the energy transition. You can see this on the right-hand side as we go through a couple of trillion per year up to multiple trillion per year. And it's across a variety of sectors: buildings, transport, industry, infrastructure. We've been investing around everything from thermostat controls in Singapore to solar, wind. Huge focus for the firm. Lots of opportunity. Let me give you the bad news. Look at the left-hand side. Every commodity that goes into this is actually inflationary. And I'll use cobalt as an example. You might know where cobalt is produced the most in the world? The Congo. You know how easy it is to get cobalt out of Congo? Not very easy. Then you go down these different commodities, right? And so you're creating a supply side uncertainty that you haven't had in the past. And guess what? 60 to 70% of these commodities, guess where they're actually processed? China. And you're talking about something where we now have a geopolitical constraint between the U.S. and China. So that's a very different scenario than extending supply chains like we did. In the 2001, China joined the WTO. You were extending supply chains. Technology was actually creating disinflation. That's not what this would suggest. Next mega theme: we want to be long security. Right? Not just security of energy because Russia invaded the Ukraine. Security of water, security of transport, security of data, right? We own power. We own several businesses in Texas. The power went out last year because they didn't invest enough in the grid. California, you got rainstorms. Our warehouses are leaking water, right? All these different things are happening around the world, in addition to all the unfortunate uncertainties that have occurred because of what's happened in Russia, Ukraine. We're investing aggressively behind this. We have multiple types of cyber firms in the U.S. We recently just bought a firm called Kober in Germany that does supply chain software. There's a ton of things to do behind this, and the behavior patterns are changing, right? What did I learn from my visit in China? It's not that the multinationals are leaving China, But when I started going to China, they were there to export to the world. China was the exporter to the world, the manufacturer to the world. Their labor costs today are 4 times cheaper than the US. When they joined the WTO, it was 44 times cheaper. Most multinationals are there in China today to sell into China. What are they doing? People are diversifying, right? They're going into Vietnam, Mexico, Europe, US. Ultimately, they're creating redundancy around their supply chain. They're increasing their inventories. And you see on the right-hand side, this is some data from the US-China Business Council. Very different approach. So, most of the time I think about investing as a cumulative sport. This is not one of those cases. This is going to be a very different environment that we're entering into. Point number 5, we own over 200 businesses around the world. We probably have as good a data on labor as most. We are definitely in the camp that we're in a structural labor shortage. I'll get to Europe in a second, but in the US, we should have 166 million people working right now. We have 162. Unlike Europe, unlike Japan, the US, when COVID hit, actually fired all their employees, and then they tried to lure them back with direct payments. Guess what? Our unemployment rate went up 1,100% at the time when Europe and Japan's went up less than 200. Structurally, that has led to a labor shortage. 55 and older are exiting the workforce at a rapid clip, and immigration has become much more controversial. What is the good news out of this on the right-hand side? Typically, when you get wage growth, which is most anybody who runs a business in the room, wages are going up, it leads to a huge boom in productivity. It's one of the reasons I don't think the CapEx cycle will fall off as much this time, because people are going to spend on both OpEx and CapEx. So let's look at the numbers here. The US participation rate is 77% for prime age females. Europe is 82, Japan is 82. Fundamentally, on the right-hand side, look at the participation of people that are 65 or older in Europe. Huge weak spot here, much below what we're seeing in other parts of the world. So each country has its own nuance, right? Japan brought a lot of women back into the workforce. They've kept people in the workforce more, but now they don't have much on immigration, and they're running into a wall. Europe's going to have to do a lot more around bringing 65 and olders back into the workforce, extending duration. The US has its own problems. Worker retraining. The US spends 1/10 of what Europe does, 1/10. And our children, the cost to help children when women go to work, it's 4x the rest of the developed markets. 4 times as expensive. And so you've had much less participation of women coming back to the workforce. There's a ton of investment ideas around this. Not only are you doing a good thing for society, but you actually should be able to make some money along the way. So let me tie it into asset allocation. As I mentioned, KKR, we cut our dividend in 2015. None of the other alternative managers did. We've retained our book values up 235% since then. We've retained about $7 or $8 billion additional dollars of capital. Today, we have over $17 billion in investments, ex cash. What have we done? So think about my job. We're 85% illiquid. We're 15% cash. So we're on a pretty big barbell. Half of that is in private equity. We've taken our real assets from 10% to 25%, and then we figured out more ways, as I mentioned earlier, in alternative credit to take advantage of what the market's giving us today. And in doing that, we found some interesting ways to actually to take up our Sharpe ratio and reduce our volatility along the way. So we are eating our own cooking. There's no other alternative manager, I think, that's here today that actually does this in-house the way that KKR does. What's the big macro point? Fundamentally, if I'm right about the regime change, look at the left-hand side here. The correlation between stocks and bonds, where you could own more equity and then own more treasuries or more bonds as a risk offset, that relationship is no longer as stable. That's a really important message if that's right. Even with the CPI coming down, the correlation is not. And so the traditional 60-40 portfolio and the traditional way that people thought about asset allocation, I would challenge that it would be as effective as it can be, certainly across asset classes. And you see that on the right-hand side. I also think our view is the dollar's weakening. The right logical thing to do the past 5 or 7 years was to be long U.S. assets. I just don't think this is going to persist as much right now. Most of the time when one sector becomes more than 25% of the S&P, it underperforms. Energy in 1982, technology in 2000, financials in 2007, and I would put forth large cap tech. It'll either be law of large numbers, re-regulation, or something will change, increase competition. And so I think the market on the equity side will change as well from a regional perspective. And so there are lots of numbers on the page. I would just put forth and challenge you, just as we're doing with our own capital, is we've thought about what can you do to mix up that traditional asset allocation. The private wealth portfolio is 30% alternatives, private equity, real assets, and then asset-based finance. And then the institutional portfolio is more illiquid. We run an 85% illiquid portfolio, which I'm not recommending, but I do think there are different ways to think about asset allocation that, if I'm right about this regime change, make a big difference. So I'll close kind of where I started, which is this is a different type of recovery, right? I started in this business in 1991. I did financials for 10 years, took Goldman public, BlackRock public, Blackstone, spent a lot of time around that. There's something fundamental going on in the banking system. And from a macro standpoint, which I started in the early 2000s, there's something going on different around monetary policy and supply side shocks. And we think it means there's a new regime. Second, embedded in that is there's a more volatile, higher resting heart rate for inflation, certainly in developed markets. And I mentioned why, right? We talked about labor, we talked about geopolitics, and we talked about the energy transition. There's definitely going to be more volatility along the way as we try to rein in all that excess that came post-COVID. But some of this is in the price. And my honest opinion is there's greater risk of being uninvested than there is being overinvested. Most investors probably own too much core real estate and office, and they own too much growth, but they're using those as blinders to miss opportunities in other parts of the market. And so I left through our action items here: overweight collateral-based cash flows, opportunistic capital, maintaining shorter duration, focus on defendable margins and cash flow conversion, and we're doing a little bit more outside of the U.S. And then finally, we've really shifted to be more thematic in how we've approached our deployment. And I think you see that in what we pursued. We talked about the shift towards services, energy transition, cyber, digitalization, automation of logistics, and some other interesting things we're seeing around Asia. So I think with that, I will wrap it up. And if there are any questions, I'll take them. But I just, more than anything, just say thank you. This is one perspective from KKR. There are lots of different views in the room, but wanted to share how we're looking at the world across our 24 offices and $500 billion in alternative assets. But thank you very much. Frank?
Okay, thank you very much. And I believe there are questions from the audience. People are still thinking and guessing. Maybe I have one question, one quick question. So, looking at these scenarios here for the next year, the next 2 years. So you're more pessimistic, more optimistic. What will happen?
I'm more optimistic. I think ultimately the central banks will stop tightening. I think the hope that they ease a lot is probably unfounded, but we are seeing a shift in our business right now. There's a lot going on around corporate carve-outs. We were the most active firm last year in terms of public to privates and infrastructure and private equity. You should expect more of that. But I think the good news is the capital markets in general are starting to heal a bunch. What people often miss when they worry about the bad fundamentals is they're actually incredible technicals. This is the best technical environment. Buybacks are way outpacing issuance. And again, when you look at, if you're a fixed income manager, there's no supply. And so I think ultimately we will have some form of recovery in 2024, and it's not going to be easy, but I don't want to be out of the market.
Okay, thank you. So?
Yes, sir.
Hier vorne, there is a micro coming. In die Hand heben.
Henry, you're mentioning that you should invest into non-U.S. assets and to grow into U.S. assets. That's kind of difficult because I can imagine that U.S. pension funds, U.S. institutionals, they hardly ever have any foreign assets. How would they ever go about that?
So, I'd say a couple things. One is I think certainly there's much more sensitivity around China right now. Our biggest business in Asia is actually Japan. That's where we've had if you're not paying attention to Japan right now, what's going on in the corporate carve-outs over there post-ABE is massive. I just did a teach-in at our KKR office here beforehand in Frankfurt. Our best performing region on the balance sheet is actually Europe. And so look at what we've been doing in infrastructure in Europe, right? We're the largest single owner of fiber in this region. We've found lots of stuff to do. So they'll have to do them through funds, and then they can ultimately do it through public equities. The China stuff will be more controversial, but if I'm right, the dollar's peaking, then I think that coupled with the fact that I think big cap tech is probably over-owned is an interesting time to shift a bit. Okay. I want to be sensitive to time. I'll be around here, but on behalf of KKR, I just wanted to say thank you, and hopefully that was informative on how we're thinking of the world, and you can incorporate that into what you're doing with your own asset allocation. Thank you very much.
Yeah, great.
Thank you.
Thank you very much.